Hey there, thanks for tuning in. Welcome to Investing in Germany. This is the continuation to the Invest in ETF series. I do recommend you watch the other videos of this series. I'm sure that you will appreciate it. Today, let's talk about the top 5 most important factors or things that one needs to keep in mind before entering into an exercise of developing an ETF portfolio. The first is, of course, the dividend. As you know, ETF is nothing but a basket of securities or stocks. Some businesses within the same basket pays dividends and some businesses does not pay any dividend. For example, Berkshire Hathaway does not pay any dividend, but Intel pays dividend. One needs to have a plan on what to do with these dividends. ETF provides two options for this: dividend accumulation and dividend distribution. Let's start with the dividend accumulation. Here the dividends are accumulated inside the fund and never reaches you or the investor. The compounding of these dividends starts automatically without any interference. In the dividend distribution, the dividend is distributed to the investor and it is up to the investor to manage the dividend. The benefit of compounding does not happen without the intervention in this dividend distribution option. What is important to know here is for the investor is that the ETF can either be accumulating or distributing. It cannot be both accumulating and distributing. In other words, the investor cannot switch between the two options by just clicking some buttons or checkboxes. So if you want to move from one option to the other, in this case, then you have to sell completely from one option and then reinvest in the other option. In this case, then you will have the additional burden of paying tax, an additional burden of spending some time and understanding and so on. If you are here for the long-term investment into the ETF, here you should have a long-term strategy on how you want to manage the dividend paid by these constituents or these stocks. The second is the total expense ratio or the TER. This is nothing but the annual cost which the ETF provider charges you. You don't have to pay this extra. This cost is deducted directly from the fund automatically and the investor will never recognize it at all. I would say this is something like an invisible cost which goes off without us knowing. Total expense ratio, this is nothing but the source of income for the ETF providers to maintain the fund and the marketing and filing those regulatory compliance certificate and so on and so forth. It is really important for you not to mix this up with the brokerage fees. The broker charges you when you enter and exit a fund. That is something for the broker, and the total expense ratio, which you don't really see it physically in a bill or any transaction, this is something that goes indirectly to the ETF provider. The third is the fund volume. The fund volume is nothing but the amount of money put in by the investors into the fund. As you know, the total expense ratio for the ETF is extremely low at the range of 0.1%. In some cases, it is even 0.2, 0.5%. For the ETF provider to make any meaningful profit, to maintain the team behind it, they need a really high volume in millions so that the 0.1% creates money for them to even break even. So while selecting an ETF, you have to make sure that you select a fund which has a higher value, because if the fund is lower value and if for any reason the ETF provider is not able to develop their fund, which means that they will be going into losses and most likely they will either merge the fund into a different fund or they will cash out, meaning that they will return you back the money. In this case, then you might have to pay taxes or even get the hit of the loss and so on, and then you have to find a different ETF fund. But I believe you are here for a very long-term perspective, then I don't think that you want to go through this pain of getting the money back, paying those taxes and reinvesting back into a different fund and so on. In other words, the higher the fund value, better it is for the ETF. And the third, this is a replication method. This is something interesting and important. The replication method is nothing but how the ETF tracks the index. For example, the DAX index tracks top 30 businesses in Germany. Here, the ETF provider, most likely they purchase all the 30 stocks and hold them in the ETF. This is called the complete replication. So it replicates all the index constituent. Some index are extremely large, like MSCI All Country World Index, where there are more than 3,000 stocks, something like that. Here, buying and maintaining the basket of 3,000 stocks is extremely difficult and expensive. So here the ETF provider will go for a partial replication. They don't go and buy all the stocks, but just some which should closely follow the index. If there are 3,000 stocks, the bottom 1,000 stocks will have extremely low weightage on the index, and therefore their impact on the performance is very, very negligible. In partial replication, these 1,000 stocks are then not held by the ETF. There are other breed of replication. This is called the synthetic replication. Here the ETF provider does not buy and hold the stocks, but they have an agreement with the financial institution and give the money to the financial institution. For example, in the case of iShares, they have an agreement with the BlackRock, their parent company, and then the agreement is like that when the ETF provider asks the money, the financial institution must meet the index performance. This may sound a bit risky because it is just an agreement and we don't know how the money will be handled by the parent company or the financial institution. But then don't worry, this is a highly regulated market and there are already a proper good risk management system in place, and therefore the money should be safe. Anyways, I personally prefer only the physical replication method, where I am a bit more into conservative investments. And the fifth, the most important, is the fact sheet. This, I would say, is a single source of truth when it comes to data and data integrity and the details of any ETFs. You will find this easily in the ETF search engine like Just ETF, Extra ETF or similar, and also available in the ETF provider websites. It's very easy to find and it's very easy to understand. You have to keep in mind that those ETF search engines like Just ETF or Extra ETF, they get the data from the third party like Morningstar or FactSet, and then they compile the data in a different UI for us. There is always a possibility of error during the compilation of these data. Therefore, if you have finalized the ETF and you are sure what you want to invest in, I would say the final step should be here to go back to the fact sheet and cross-verify all the data that you have used to select the ETF matches with the fact sheet, and then you go and invest in it. In the next video, we will go through developing a complete ETF portfolio for educational purposes. So stay tuned, subscribe to the channel. See you in the next video.